Hi friends, Srinivas here. This is the sixth video of the technical analysis series. So in the last video, we talked about stop loss. This video, we're going to talk about position sizing, targets, risk to reward ratio, and so on. Okay. So what is position sizing? Whenever you take a trade, whenever you want to buy some shares, question arises, how many shares should I buy? Should I invest all my money in one trade? Of course not, right? Because never put all your money in one trade. It's like putting all your eggs in the same basket, right? So we should never do that. So how do we calculate the number of shares to purchase? See, for a bullish trade, the calculation can be done as below. And for the bearish trade also, similar calculation will apply. See, what we are saying is, let us say the per share maximum loss which we are ready to take, let us call it A, okay? That is nothing but purchase price minus stop loss price, right? Because let's say I purchase a share at 100 rupees and I expect it to go to 110 rupees, that's my target, okay? But I feel that if it starts going down instead of going up, when it goes down to 95, I'm going to exit and I'm going to exit the trade with a loss, okay? So my stop loss price is 95, right? So my purchase price is 100, right? So the maximum loss per share I'm willing to take is 5 rupees in this case, okay? And per trade maximum loss we are ready to take is can be called as B, let us say. And usually what traders do is they have a total capital for trading, okay? Let's say they have a budget for a year. Let's say, just to give an example, 1 lakh rupees is my budget for 1 year for purchasing shares in equity and making profit out of that. If for every trade, they will allocate only 2 to 2.5% of the total capital, okay? The total budget, total capital they have, only 2 to 2%, 2.5% of that they will allocate per trade, okay? So the maximum number of shares you can buy for the trade is nothing but B divided by A, is it not? Because see, if I allocate some money for the trade and all of this money is at risk, okay? And per share I am willing to take a risk which is denoted by the letter A, right? And the money I am putting as a risk in this trade is B, okay? So number of shares I can buy is nothing but B by A, right? So for example, in our Infosys case, let's say our total capital is 1 lakh INR for or 100,000 INR for the entire year, and for this trade, if I'm putting 2% of that, so I have 2,000 rupees, which is the number B. And if you see my mouse cursor, what is the A? A is nothing but the price at which we are purchasing. That's 752 if you remember the last video, and minus the stop loss, which in the first time when we purchased the share it was 735. So basically, this gives 2,000 divided by 17, which comes to 117 shares only. Okay. Now what happened when we did the first trade? If you remember, our stop loss was hit and we had to exit the trade. So what is the loss we incurred the first time? It is 117 shares into 17 rupees per share. We had a loss. So total 1,989 INR we were in loss. Okay, that's what happened the first time. Okay, so the second time, let's say we are able to spare 2.5% of our total capital, and our if you remember, our purchase price was 729, our stop loss was at 700 if you remember. So the number of shares we can buy is nothing but 2,500 divided by 29, that is 86 shares only. Okay, so what is the profit we made? We made 24 rupees profit per share, 86 multiplied by 24, so the total profit was 2064 INR. Okay, now after both of these trades, the effective profit we got was 75 INR, right? Because 2064 profit, 1989 rupees loss, so effectively our profit was only 75 INR. Let us say that this trade we took in a month, okay? And such trades, we will take one trade per month. Let's say there's a trader who takes such trades once in a month, okay? So if you look at the ROI, it is we got 75 rupees upon our 4,500 rupees, because first time we put 2,000 rupees, second time we put 2,500 rupees, so total 4,500 rupees we put, and we got back 75 rupees on top of it. So if you calculate the percent, this is 1.6% per month we got the return, okay? If you compare it to FD, FD will give you a 6% per annum, okay, max, okay? That is 0.5% per month. Okay, so here you're getting 1.67% per month, which is more than 3 times what the FD returns gives you. So definitely, stock market is a higher reward situation, but a higher risk as well, because in FD you're guaranteed to get this return. Okay, but in the stock market, unless you very intelligently with a steady mind do your trading, the returns that you get might vary. Okay, you have to trade intelligently and ensure that you make some profit every month, and that will allow you to get more returns than FD. Okay, FD is guaranteed but less profit. Stock market is a higher profit, but there is no guarantee unless you are intelligent and you trade with a steady mind. Okay, so that is what is known as position sizing. It gives you how many shares you can buy. Now let's talk about target and risk reward ratio. Okay, so the question we want to ask is, how do we know at which price we should sell? That is, what should be our target, right? So basically, if I buy a share at rupees 100, should I sell it when it goes to 110, or should I wait for it to go to 120? So what should be my target? Okay, so how to know what the target price at which we'll sell should be for a bullish trade? How to ensure that it will give us profitability overall? Okay, so to answer this question, we have to think of 3 things. One, the target depends on the chart pattern. So if you remember, we had indicated that if you get a inverted head and shoulder or a double bottom pattern, the distance between the neckline and the bottom line is expected after the breakout. Okay, so that can give you some hints, and your supports and resistances can give you some hint saying that the price could go up to this. And thirdly, there is a ratio called the risk to reward ratio. What this means is, you take your possible profit, that is, if I purchase my share at rupees 100 and I'm expecting it to go to 110, that is my target is 110, which means my possible profit is 10 rupees. And let's say I put my stop loss at 95 rupees, which means, my purchase price 100 minus 95 is 5 rupees. So my risk to reward ratio, okay, it's actually reward to risk ratio. Okay, it's called risk reward ratio, but the numerator is the reward, which is 10 rupees, and the denominator is the risk, which is 5 rupees. So my reward to risk ratio or risk reward ratio is 2 in this case. Okay, so you have to consider all that, and there is a tool called the long tool for bullish trade in tradingview.com, and we can use that, and we can have a look at it. So let me go back to Infosys. In tradingview.com, you saw this situation in the last video. So here what I'm going to do is I'm going to use this tool here. If you can see my mouse cursor on the left, this is called the long position tool. The long position tool will just allow you to, given your entry price and your stop loss, it will tell you what your target must be for a desired reward to risk ratio or risk reward ratio. Okay, so if I am taking a bullish trade, I'll take the long position tool. If I'm taking a bearish trade, I'll take the short position tool. Okay, now since both the trades we have taken are bullish, I'll take a long position tool. And what I will do is, see, on this day we bought at 752. So I'll just go near 752 and do a single click. Okay, once I do the single click, it will give you this tool, and I will pull this bottom blue rectangle till it comes to my stop loss. Okay, and I will ensure that this middle part is my buy price. Okay, and I will move this target up so that can you see the risk reward ratio here? It is showing as 1.07. I will move it till it becomes 2. Okay, so this is again a sort of subjective between trader to trader. Some traders say I need a risk reward ratio of 3 only, then I'm going to go ahead for a trade. Some traders will say, yeah, even if it is 2, I'm going to take the trade. So it is subjective, but at least it is good to have a numerator reward to denominator risk ratio of 2, so that the profit you will be making is twice the risk you're taking. Okay, so if you're taking a 5 rupees risk, you should aim for 10 rupees profit. Okay, so that's the moral of the story. So once you use this tool and you ensure that the risk reward ratio, you can see it changing here. Once you ensure that your risk reward ratio is 2, the top portion is what's your target. So if I put an alt H there, and if I right click and I say settings, see 786 is your target price. Okay, in this way you can sort of assess if your stop loss is this and if your entry price is this, what your target should be. That is till where you hope the prices to go up, so that you can sell it at that point and ensure that you have earned the profit that you are hoping for. Okay, so that is what is known as target, and that is what is known as reward to risk ratio, or usually called risk reward ratio for short. Okay, RRR. Now the second time we took trade, I am going to do the same thing. We bought it at 729. Our stop loss was at 700. I will enable this long tool again. I'll go till my 729 and I'll click it here. I will bring this down till it touches my stop loss, and I will ensure that this is near where I purchased, and I will ensure to put the target so that my risk to reward ratio is at 2. Okay. Again, it sort of is subjective. Some traders will put it at risk reward ratio 3 and take a trade. Some will put it at 2. So it depends on the trader. So even for this case also, you can see if I hit a target of 786, you see this purple line, I will sort of ensure that I have met my risk reward ratio. Okay. So if I go back to PPT, so basically, risk reward ratio was the first case. The target will be 786 and risk reward ratio was 2. And for the second case also, the same target will give you a risk reward ratio of 2. Okay. So if you see a reversal happening before meeting the target, you have to exit the trade and book profits. So what does this mean? See, it again depends on the trader and how he or she trades and what kind of risks he or she is willing to take. For example, in the second case, see, the price started going up. Okay, now the price here was 753 when we sold it, and it was never close to the target of 786 that we had. Okay, now the question comes is, when you start a reversal here, should you sell it, or should you wait for it to reverse, bounce back and go up? Okay, so that again depends on the trader. It's very subjective, because some traders who are very aggressive, who are very risk taking, will say, see, I have put my stop loss at 700. Okay, and there is no way that it is going to come back till 700, because the support at 707 is very strong, and it will bounce back. Okay, so what they will do is, even though they see a reversal happening before the target is hit, they will let the reversal happen. They will let the price come to, let's say, 729 or 735, some level like that. They will let it bounce, they'll let it go up, they'll wait till it goes to the target of 786. Okay, that is some traders who are willing to take a lot of risk. Some traders will say, no, as soon as I see a reversal happening, and before it goes to a downturn and I start losing on my profits, I will sell it. Okay, so that is some traders who are less risk taking. Okay, so it completely depends on the trader what he or she does. But as a beginner trader, I suggest that always before meeting your target, if you see the reversal happening, you just book your profits. That is, you sell your shares for a higher amount, book your profits and exit the trade. Okay, so this is what I suggest. Second thing is, if your target is met, then see if you can trail your stop loss for extra profits. So what does trailing the stop loss mean? Let us say that our let me just delete this. Let's worry only about the second time. Okay, so assume that in the second time you have set your stop loss and you bought it at 729, and assume that your target was, just to give you an example, don't worry about the risk reward ratio and all that in this case, just assume that your target was around 737. Okay, you bought it at 729. Let's say for some reason your target was at 737. So let's go to settings, make it 737. Okay, so this was my second times target. Now let us go back to this day. Okay, so we'll use our tool here again. So basically we'll use this button. We'll go to this day and we'll click here. So it is as though we are on this day. Okay, so if I just hit it, my second times target has been hit. Now the question is, should I sell, or since I have met my target, should I wait for more? So again, here is where it is subjective and differs between trader to trader. Some traders who are less risk averse will say, okay, I met my target, I'm happy, and I will book my profits. Okay, sell my shares at higher price and book my profits. Some traders will say, see, there is no signal that this share is going to go down. So in all probability, it is going to go up. Okay, so why don't I wait and watch and sell only if it starts going down? So what the trader will do is he will take the stop loss, he will bring it up, and he will bring it very close to his target. Usually whenever you are trailing your stop loss, so let me go to the settings here. Second time instead of stop loss, I will put in bracket trailing. Okay, so we are trailing our stop loss not at 700, but we will put it few rupees below the previous candle's low. Okay, so this is a standard procedure in trading. Some traders will put it at previous candle's low point. Some will place it a few points lower than that. So, but essentially, what we are saying is, till it starts going below previous candle's low point, let us not sell. Okay, let us hope that it goes higher. So this is what is known as trailing the stop loss. So we will put this trailing stop loss. We will put it at 732 in this case. Okay. So what we are basically saying is, see, it has gone up till here. Okay, now I will wait for it to go up. But even if in case it comes down, I will sell it at a point where I'll still be profitable. See, you bought it at 729. So even if it comes down to 732 and you sell it, you'll have a 3 rupees profit still, right? So this is what is known as trailing the stop loss. My stop loss is no longer what was 700. I have trailed the stop loss to be a few few rupees below the lowest point of the previous candle. Okay, so let's see what happens. So luckily for us, our trailing stop loss is not hit. It is getting increased, and then the reversal happens, and then we can sell it here. Okay, so this is what is known as trailing the stop loss. So it completely depends on the trader, and when you get more experience, if you see the price is still going up and you'd like to make more profits, then definitely trailing your if your target is met, if you can trail your stop loss, you can sort of target at some extra profits. So this is the moral of the story. Okay, so till now we have talked about Dow theory, we've talked about trends, views, supports and resistances, we have talked about candle patterns, chart patterns, indicators, we've talked about stop loss, we have talked about targets, we have talked about trading the stop loss, we have talked about risk reward ratio. So can we not use all this information, and can we not come up with an algorithm to ensure that we take the proper steps while trading and ensure that we are always, most of the time, 70% of the time, profitable? So we'll discuss about that algorithm in the next video. Thanks.